Some basic rules and requirements for a 1031 exchange for every investor, small or large. Very simple. First, we need to remember the timing restrictions. From the date of the sale of the first property, we must identify new properties within 45 days. And we must acquire from that list within 180 days or the due date of your tax return, whichever comes first. So, for example, a taxpayer who sells relinquished property early in the year gets the full 180 days, but a taxpayer who sells in November, their 180-day deadline would fall after April 15th. So they would either need to complete their 1031 exchange before April 15th or file for an extension on their income taxes. Note, you can file for an extension on your income taxes, but you cannot file for an extension on your 1031 exchange. So those are the timing restrictions. Additionally, there's some very simple mathematical restrictions or suggestions, if you will. In order to fully defer the taxes, the taxpayer should exchange into new property equal or greater in value to what they sold, and they should reinvest all of the cash. An investor who exchanges into a larger property or a more expensive property, but takes out a much bigger loan so that they end up with cash at the end of the exchange, still creates a taxable event even though they bought a larger property. And then I guess the other most important thing in this very short list would be that this applies only to business or investment properties. It does not apply to your primary residence. It does not apply to a second home or a beach home or any other third home, whatever you may have. All of the properties involved in the transaction must be primarily used in a trade or business or for investment.